You're listening to the Real Estate Runway podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. This will be Chad's Talk edition. You've heard of TED Talk. This is a corny version called Chad Talk, where I get on a soapbox and just talk about a topic that is relevant today. So what are we going to get into today? Let's talk a little bit about the art of the deal versus the art of the debt. How is it different? Why does it matter? But before we get into that, folks, if you get any value out of the show, please scroll down in whatever modality you're listening to the show in, leave us a 5-star review and a thoughtful comment. It is the best way to grow the show, and we so appreciate you for doing that. And we appreciate all of you as listeners. If you want to reach out to us, give us some content requests, some feedback, or just say hello, hit us up at podcast@thequattroway.com. And if you'd like to apply to be on the show, find us at thequattroway.com/podcast. As always, you can follow us via our parent company, QUATTRO Capital, at Team QUATTRO Capital, no spaces or special characters, on Instagram, Facebook, LinkedIn, you name it. So looking forward to seeing you on all those modalities. But without further ado, let's get into today's episode. So the art of the deal versus the art of the debt. Why does it matter? You've probably read a book by Donald Trump, if you're a real estate investor, called The Art of the Deal, or at least heard of it. The art of the deal is, I'm not promoting the book, but I am promoting the concept. The art of the deal is really the art of real estate. The deal is only as good as the contract price you put it under. It is only as good as your ability to execute on the negotiation. It is only as good as how you set it up in the front. Like, how do you finance it? How do you, structure the equity? How do you structure the contract with the seller? What do you get rights to when you buy it? That is the art of the deal. But I find often people are spending much too much of their attention on the deal itself and not focusing on the art of the debt and the art of the equity. We're going to focus on the art of the debt today because the capital stack really, really is the most important, in my opinion, part of any real estate deal. And so let's talk about the art of the debt a little bit here. Why is debt important? Well, for one thing, debt can make you or break you. It can make a wonderful deal better, and it can make a wonderful deal awful if you do it wrong. So let's think about why it's important. It is your biggest investor in the capital stack. The capital stack being the entire, think about the pyramid of money that you use to buy a property. The debt is probably the biggest one. It's probably the cheapest one, and it's probably the one that has the most teeth if you don't treat it with respect. So think about that a little bit because, the different flavors of debt you could put on a deal are going to impact two things, right? With any loan that you may choose to put on a deal, it impacts your staying power, for one, and your earning power, for two. What do I mean when I say that? Staying power is your ability to retain the deal and maintain position as the lead operator or the owner of that deal. In some cases, those are both one and the same. But that's your staying power, being able to maintain that position. If you have too much debt, let's say, so let's just say we go to an extreme and you buy something with 99% loan to value. Nobody ever does that. Why? It's stupid, because you think about, okay, well, yes, I have 99% loan to value. I have 1% equity. So I'm probably going to make a lot of money on that money if I do well with the deal. So your earning power is very, very high, but your staying power is so low, like to the point to where your cash flow will probably be so tight or so negative that as soon as you either bleed out of cash or one thing goes wrong, the bank is going to come foreclose on that property and remove you as the owner and operator because you have minimized your staying power in lieu of maximizing your earning power. The same goes true the other direction. To drive the analogy home, what if we bought a property with 1% loan to value? It's almost not worth the trouble, right? But again, that is stupid. Why would you do that? Well, okay, fair enough. Many of you are probably saying, wait a minute, I'm a cash investor. I don't put debt on my properties. Well, that's okay too. But recognize that you're minimizing your earning power and maximizing your staying power. What do I mean when I say that? You could take that same money that you're buying one property with and probably go buy 3 properties at reasonable leverage, maybe 60%, 66% reasonable leverage if you broke that property across 3 instead of 1 at 100% of equity. And so what you're doing there, when you take 1% loan to value, back to the example, you're maximizing your staying power. Like I would bet you probably everything I own that if you do a deal at 1% loan to value, which is effectively no debt, no lender's ever going to come talking to foreclose on your property because you're not going to really have any debt service to worry about. And so really it just comes down to, hopefully you're operating well enough and making money on that, but there's really no one going to come knocking at your door unless you don't pay your taxes. So you're really maximizing your staying power with that situation. Well, we as investors, we like to make money. So what do? We optimize. We optimize. There is no one black and white answer for everything. We are always optimizing in the design window, okay? So what we try to do here is we figure out what is the most efficient amount of debt proceeds, and this is expressed in a percentage that we put on a property, that will enable us to maximize our earning power, but optimize our risk, right? And so today, in this environment, that usually winds up being, anywhere from 50 to 70% loan to value. And I think in much more aggressive times, we've seen that get as high as 80, 85, which I think is aggressive and silly, but some people do it. If you're confident in your business plan, that's all that matters. So let's talk a little bit about the different kinds of debt and how you can optimize that, that staying and earning power. This is really the art of the debt, okay? So talking about the different types of debt we have, we know that we have we're just going to lump them into buckets, okay? You have short-term debt, which is usually termed bridge loans. They're usually made so that you can go fix a property. They'll give you some construction proceeds as well, and then you get it ready, you bridge it to the permanent financing, okay? So that's kind of short-term debt. Medium-term debt, I look at that as bank debt, okay? Bank loans, on average, I know there's umpteen million flavors of bank debt out there, but on average, bank debt likes to be about a 5-year loan, give or take, okay? They don't really like looking beyond that. They'll give you renewals, but they want to reevaluate it every 5 years. And then you wind up with the conventional long-term loan. Now, this is your Fannie Mae, your Freddie Mac, your Ginnie Mae. So all of those loans that you either buy a house with or that you put anywhere between a 7 to 20-year term on your debt. CMBS falls into this category. Those are usually 10-year loans. And, then, so you really have those 3 buckets of we'll call it loan timeline, okay? And then kind of this is a bonus part, but overarching, you kind of have life companies, and they'll do a little bit of everything. They do some short-term debt, some medium-term debt, some long-term debt. I'd say they emphasize on long-term debt because they just don't want to be recycling transactions. They really prefer to put all that money out there they get from your insurance premiums and just let it sit and grow. So, but that's neither here nor there. The point is, you have these 3 different buckets of timing on your loans. So the art of the debt, when you come back to thinking about where we are today in this environment, we're still in this rising inflation, Fed rising interest rate, everyone's trying to squash inflation at the expense of the economy, all that kind of stuff. Well, go back to the art of the deal. It doesn't really affect the art of the deal. The fundamentals, on how real estate is performing, how rents are performing, it's not decoupled totally, but, it's not a direct relationship. You have, you still have a overarching supply and demand problem. You still have households being created, or at least even if they're being created at a lower rate, we're still seeing the positive impacts on the deal. But coming back to the debt is drastically impacted because you're seeing interest rates rise very quickly. Well, when you're optimizing that debt, some schools of thought might suggest, well, I don't like floating rate debt right now because it's moving on me, so I better lock in a long-term rate. Well, that's actually a mistake, because if you lock in a long-term rate, let's say 10 years right now, I can pretty much tell you with not certainty, but a high level of confidence that you're probably going to experience a lower interest rate within 3 to 4 years from now than you have today. So if you go ahead and lock at what may be the peak, and we may go a little higher as of this recording and on January 6, 2023, but if you lock now kind of on the upper end of the interest rate curve from where we were, you're unlikely to see any of the benefits of when the Fed goes the other direction and starts to ease off rates a little bit and get them to a new normal once inflation gets under control. So you really want to think about the longevity of your loan, what rate you're locking in, so that the short-term debt, we had short, medium, and long-term. Long-term debt is fixed. Short-term debt is almost always floating, rarely fixed. And the middle stuff can kind of do both, but I would say it's mostly fixed as well. But the difference is the long-term debt, it's fixed with a large prepayment if you don't keep the loan long-term. The medium-term, not so much. You might not be fixed, but you might be fixed with a 1 or 2 year prepayment. So you're probably going to want to play on medium to short-term debt right now so that you're not kicking yourself when rates are back to 5% and they're at 7% now or whatever crazy they are. Even if they don't go back to 0 or back to 2 or 3, we're 5%, I think I would argue, is still better than 7%. So think about that. But now let's talk a little bit about optimizing proceeds. We were talking about the capital stack and the overall cost of capital. And what does that mean? In any capital stack, you're going to have typically the senior lender. That's your debt. That's usually the biggest part of the triangle at the bottom. Then stacking on top of that, you're going to have a little smaller slice of the triangle. That would be your your mezzanine debt or pref equity or things of that sort. And we'll talk about the differences in those, but those are pretty much debt the way you need to look at it. Both, whether it says equity or not, it's going to function and feel like debt for all intents and purposes. And then above that, you have, common equity. And then above that, you have sponsor equity. So usually you as a sponsor are going to be at the bottom of the stack, the top of the pyramid, but the bottom of the hierarchy. So think about that. But let's go focus in on the debt piece. The art of the debt is what we're talking about today. If we look at the pref equity / mezzanine debt, I know I just said equity, but just for all intents and purposes of this conversation, pref equity equals mezzanine debt. And I'll talk about why that is in a minute. You may only get, let's say on a deal you're doing, you may get 50% loan to the value on a medium term lender, just based on where cash flows are with the current interest rate. This doesn't mean there's anything wrong with the property. The property may be fine. There may be a ton of upside on it, but debt service coverage ratio is a little bit different on a 3% debt than it is on a 6% debt. So you got to remember this. So if we go and talk about how to optimize that debt a little bit, and then I did this recently on a deal, right? We chose to go with short-term bridge debt, but we bought an interest rate cap on it, which is, and I mean an aggressive cap, like 1%. So basically we had a spread over SOFR. SOFR is at like 4.5% right now, but we bought a 1. So that insurance policy will never let us pay over, 1% SOFR. So we kind of artificially put a ceiling on our rate. So that's one way you can use short-term debt in uncertain times, right? To kind of bridge you through the uncertain times. But there are kind of 3 different things you can do with your loan. One, you can add, I'm going to say 2. I'm going to combine these 2 together. You can add pref or mezz, or you can go after a B note. Let's talk about what those are. So let's say that same lender, we're going to go with 60%. Let's say that lender gives you 60% at 5% interest, right? Okay. Well, if you think about the cost of your equity, you now have to come to the table with 50% loan to value, for a 60, it'd be an additional 40% loan to value, plus closing costs, plus any CapEx you need. So you're probably going to be, at 40 plus, let's say another 55% of your loan to value on equity that you bring. Well, whether it's your equity or it's someone else's equity that you're raising, equity is expensive. If I look at what I want to make on my equity, even if I just invest in my own money, I want to make north of 20% annualized. I'm not trying to make 4, 5, 6%. That's not a good deal for me. I could go sit in a mutual fund and do that, right? So, or I could be the lender. It's a very different thing. So if I'm playing the equity game, I want a big, expensive multiple. Think about the numbers. Forget the fact that it's equity versus debt. If I'm paying the debt 5% per annum, and I'm paying my investors 20% per annum, that is a 5 or 4x multiple on the cost. So wouldn't it make sense to try, if your deal can support it, if you're not jeopardizing your staying power, to get a little more debt proceeds on the top of the senior lender, right? And now let's think about what that's going to cost. And now I'm going to put a plug here. Why is pref the same as debt or mezz debt? It's not the same. It's really not, but it is functionally the same. So the way mezzanine debt works is you would basically give that lender, that's a second position lender, and so the senior lender will always have the first lien on the property, the first lien mortgage on the property. The mezzanine lender, they may go after what's called an equity pledge. So, they're not going to let the senior lender foreclose and take over the loan usually. So what they're going to do is they're going to make you, the borrower, pledge your interest in the LLC that owns the property to them conditionally, saying, hey, if you default on our mezzanine debt financing and you're in default on the senior loan, we're going to get you out of the way. We're going to take over and we're going to make sure our money doesn't get lost to the senior lender, right? Usually this takes the mezzanine lender and the senior lender getting comfortable with each other, but it's basically a second position loan, okay? The main difference between mezz debt and pref equity is debt, equity is equity. So debt does not share in any sort of the allocations of taxable benefits or losses or anything like that for the property. So you're not going to get, the lender is not going to take a share of depreciation, for example. Now, pref equity, it functions about the same way. Like it's still going to look and feel to you like a mezzanine lender economically, but instead of negotiating with the lender, they're going to negotiate with you and they're going to weasel their way into your deal, your equity stack. You're going to pay them first. It's basically going to be a debt service payment. And similarly, if you don't perform, they can pull you out of the way and make sure their money doesn't get lost. So they both have the same amount of teeth. The main difference is the pref equity is going to have, it's an equity source, so it's actually going to have some share of the taxable losses and depreciation and all that kind of stuff, right? So I digress. Back into it. So just walk with me and say pref and mezz are the same thing for this conversation. I can approach, back to our lender with 60% loan to value, I can approach a pref or mezz originator and get them comfortable with our deal and with the lender that's in front of them and say, hey, I need a little extra money on this deal because I don't want to put my expensive money for all the what's in there. And so I'm just going to use a right now example. The senior lender's at 60% LTV. The mezz and pref guy might be able to do another 10% LTV. So now you're at 70% loan to value. Okay, well, that's starting to look more like a normal deal. So because the mezzanine or pref lender is not a senior lender, they don't have the first lien, there's somebody in front of them, right? The senior lender's in front of them. That means their risk is a little higher. So they're gonna charge you more than the senior lender, so more than 5%, but it's going to be a lot less than 20%. So that number could be anywhere from, 9 to 12, 13%. It could be higher, but I'm going to say it's between 9 and 12%. Well, now a magical thing happens. This is where the art of the debt just started to click. Now, if we look at our capital stack, instead of averaging, and I'm just going to use round numbers. Let's say that in one scenario, we have 60% loan to value and 40% equity, 60% debt, 40% equity. Remember, debt costs 5%, equity costs 20%. If you do a blended average of those things, you're going to have, interest, a blended cost of capital, A. Now let's go look at blended cost of capital B. If we put our senior debt in place at 60%, and that's a 5% loan, and then we have another 10% at, let's just call it 10% interest, another 10% LTV at 10% interest. Well, if I blend those two together, that 70% of cost of capital is now less because I was originally paying 20% on that extra 10% with the equity group. So you can really start to see how the cost of capital can be optimized while also considering your staying power. So I've just increased my earning power by taking some cheaper money from a mezz lender, but I've diminished my staying power a little bit. So how do you mitigate that risk? And let's think about what we can do there. So if you're using short-term debt, like in this example, the number one thing you have to think about is, okay, Well, number one is, can I service the debt? As long as my cash flow, or I have enough money in the bank to service the debt until the cash flow will service the debt. Okay, so I'm safe to service that debt. That means I'm not going to get into trouble. But you have to also think about what happens when you need to get out of that short-term loan. Short-term loans may be 2 to 3 years plus a couple years extensions, right? So you may have up to 4 or 5 years, but you're going to have to qualify for the second 2 parts. So let's say you have 3 years, for argument's sake. You have to be willing to say, okay, if I'm going to take 70% loan to value on the current value, you have to be able to think about what your refinance environment is going to look like 3 years from now. Now, you can use things like Pensford.com and Chatham.com and to look at current and forward projected interest rates. It's not going to be a crystal ball. If it was, we'd all, those companies would be a lot richer. But it's going to be a good indication based on all the leading market experts of what rates are going to look like in the future. What you have to do is figure out, okay, I'm taking this extra leverage from a mezz lender. Do I feel confident that I can not only service the debt, but that when refinance comes up, I'll be able to get the debt refinanced out? And you have to kind of look at a tolerance band, like say, okay, well, what if interest rates are 4.5 all the way to 6.5 or something like that? And you have to look at it and say, okay, well, could I go get, and I usually check this based on agency loans, like Fannie, Freddie, Ginnie Mae, right? I look at, okay, well, what debt coverage are they going to require? Usually, depending on the market, it's 1.25 to 1.3. What leverage will they give me? Usually, and I usually check it at 70%. And then the next question is, okay, well, at my projected net operating income, what is my debt coverage ratio at those different interest rates? And you can build yourself a quick little table and figure out, okay, by increasing my earning power, have I really affected my staying power? And if in all situations that table holds true, then you're good. But if you start to say, okay, well, hey, I can actually put 25% from this mezz lender, they'll give me that. Yeah, you just increased your earning power a lot. But I bet if you go look at your refinance table, you might have, 2 or 3 of those cases where it might be kind of getting a little dicey on the refinance. So these are ways this is the art of the debt, folks. The art of the debt is just as important as the art of the deal because it can make you or break you. Okay. So we're going to conclude the episode here. If you got any value out of this show today, please, please, please leave us a 5-star review. I would greatly appreciate it. The team would appreciate it. We put a lot of effort into these shows for your benefit, and we love talking with you. If you want to reach out, again, we love talking with you, podcast@thequattroway.com. And if you want to follow us on social media at our parent company, Quattro Capital, Team Quattro Capital, no spaces or special characters. There's, of course, words in there. And, until next time, this has been the Real Estate Runway podcast. We appreciate you all, and keep your eyes on the horizon. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.